It's not intuitive to trade. It's just very difficult to do the right things.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders podcast.
Welcome to Two Traders. It's Walter here. Hello, Darren.
Hello, Walter.
Yeah, so Darren, we've got this interesting idea about reversion to the mean trading systems. And I was thinking that as traders, you can go and find on the internet, there'll be forums where people are talking about some sort of a Martingale system. And we all know that while they make really nice equity curves, or can make a really nice equity curve for a long time, eventually they completely crash into a fiery ball of flames, and so will your account. But my question is, the reversion to the mean trader. Reversion to the mean is actually a pretty popular style of trading. And for those of you that don't know, I know most of you know listening to this, but some of you might be, what are you talking about? Well, an example of a reversion to the mean was, let's say you have the 34 exponential moving average, and you basically trade the market back to that moving average. So if it gets really far away, maybe it spends, 25 candles away from touching that 34 moving average. For example, if it fell below it and the moving average was above it, you might buy up to that 34 moving average. But let's say that you did that and then the market moved further away from that moving average. You might have another signal to buy. And so what happens with these reversion of the mean traders is some of them, not all of them, but some of them will have signals, and then the trade goes against them and they'll get another signal, and then it'll go against them and they'll get another signal. So my question is for you, Darren, with this style of trading, is it really that far removed from martingale trading? And is it possible that they might blow up your account just as a martingale strategy might? So I'm curious about your thoughts on this.
Yeah, I think there's similarities to martingale, and this style of trading is really popular. And I know a few people who pretty consistently successful over a long period of time trade in this way. I can see the appeal of it, because really what you're doing is you're never really accepting a loss, because the chances are sooner or later that move has got to retrace, and that's where you recoup these trades that are caught in drawdown. Whenever there's like a positive side to a particular approach to trading, I think what we often do is we gloss over the sort of negative side of it. And say, for instance, in your example, you would see a high number of sort of net winning positions. But what tends to happen is, your winning trades are kind of recovering from the ones that were in the most drawdown, and you tend to have your actual real profit is fairly small. And then obviously, sooner or later, it's going to keep moving against you, and you're going to have a cut-off point at some point, and that's where you have a very large win. So, basically what you're doing is you're saying...
Large loss.
Loss. Sorry, right?
Yeah.
Yeah. Exactly. That's glossing over the negatives again. You tend to just see the positives.
Yeah.
So you've got to accept, I think, however you trade, that if your strategy has a very high win rate, then there's going to be some sort of element of that means that your losses are relatively small relatively large compared to your wins. And I think what people want to do is they want to kind of break that equation. And for me, the parts are all interwoven. You can't stretch alpha so far out and remain there. Do you see what I mean? The edge tends to be much closer to the mean.
Right.
Really, your results. If you're a good, consistent trader, it's unlikely you're going to hit the ball out of the park year after year after year. You're going to probably see, your average winning year is probably not that impressive. And if it is, then you're probably doing something like martingale, where you're hoping that the inevitable never happens, really. And I can see the appeal in that. I really can. And in some respects, it feels like a much easier way to trade. But to do it successfully over a long period of time, I know one trader who he lives in Thailand. He's got a couple of houses there. He just trades gold, and he trades something very similar to this. He does very well and consistently makes gains, and until the market starts to trend. And just recently, he has taken a very large loss, and to the point that he completely stopped trading for a bit and just, refocused and is getting back into it now. And that element is always going to be there, and I don't think you can avoid it. And I think a lot of people seem to think that their version is going to somehow avoid that. So yeah, that's my thoughts.
Yeah, it's interesting. I think you're right. I think that's kind of what that style of trading does, is it attracts people who don't want to take the loss or like the idea of slowly building up their account. But occasionally what you'll see, and listeners can go back on the charts and see this, occasionally what you'll see is that the price will get away from the moving average for a long time. And when it comes back to it, you have to ask yourself, where were those original positions, right? They're all underwater. So you know what I mean? So you take that buy trade because the price has fallen away from the moving average, and then it keeps falling lower and lower. Finally, what happens is the moving average catches up to price. And so it's not really that you're making a lot of money on the trade, because all of your all of your original positions that you first started taking, they were all up much higher. And so now you've got the signal to close the trade, and you're like you say, you're closing them at a loss. So what do you think you can do if you want to trade this way? What's the solution? How do you deal with this style of trading if you want to make it work?
I think you need to kind of focus on that fact that trying to avoid too many losses is going to give you that scenario where your wins are too small and your losses are too large. So you kind of have to decide on where the cutoff point is, and you need to be really strict on that. You have to say, okay, how many positions am I going to let it go against me before I just cut the lot? The danger is you say, okay, well, let's say every 50 pips after my first trade that it goes against me, I'll add a trade and I'll do a maximum of 3. And once that third trade triggers, then I'm going to, put the stop losses in. And, if it goes any more, then I'm out of the position. And obviously, the difficult thing then is going to be, okay, so how many positions and where am I going to place the stop loss? And then you have to follow through on that. And, it's going to be really difficult to pick that level, because you could test it on 1 year and say 4 positions was brilliant. You could test it on the next year and 4 positions is terrible. It would be very difficult to find something that always is optimum, if you like. And then, at the other side of the equation, you've got the problem, well, when I've got to that maximum 4 positions that underwater, when am I going to get out? Am I going to get out at break even? Am I going to get out at a small loss? Or am I going to then hold them and try and generate a large win out of them? You're kind of still stuck with the same dilemma in any approach to trading. But you have that risk of wanting to never lose and then trading for a very long time and not getting anywhere. Yeah,
exactly. Yeah. I mean, it's so tempting to embrace a trading system where you keep getting all these little winners, and then kind of don't want to think about the big loss that's looming. It reminds me of Victor Niederhofer, who basically did that he's done it a few times where he trades that way, where he writes options, naked options. So he doesn't actually own the underlying asset, and he'll write options for these. And every day, every week, every month, he's making a little bit of money. And then all of a sudden the market has a huge crash and all these options have come good, and he's got to pay up. It's kind of the same thing. So my thinking on this, Darren, is that there are traders on the other side of this, and I find this fascinating, because if we talk about the traders who are reversion to the mean, and they're in a situation where the market's moving strongly, and so they're hoping that the market turns around and goes back to the mean or to the homeostasis part of the chart. There are other traders who are actually waiting for these opportunities when the market takes off and gets to the edge of the Bollinger Band or far away from the moving average or has a 54-day breakout or whatever it is, there are these trend followers. And there are also traders who will add to a position as it becomes more and more in profit. So it's kind of the opposite. So because these reversion of the mean traders, they're adding to a position that's in drawdown, it's a losing position. They're adding to that. Whereas there are traders that do the opposite. They add to winners. They look for trends. They try and capitalize on that. So my thoughts are, we've identified some of the problems with the reversion of the mean systems where you keep adding, positions, and maybe some ways that are out of that, like you say, like maximum number of positions, maximum level of pips that the market goes against you. You decide, okay, now that's it, I'm going to cut. Or maybe you could use a time exit. You go, look, I've been in these positions for 10 candles, it's time to get out, or whatever you choose. But these other traders on the other side, this is what's fascinating to me about the markets, is we always have somebody on the other side. And so what do you think about these traders who trade at the edges? They look for these opportunities where the market gets far away from that midpoint, and they look for opportunities to add to their position when it goes in profit. What do you say about that?
Well, I definitely think trading at extremes is a really good approach to take. So yeah, when price is stretched is a great time to trade. But the thing I would say would be, do you know more traders that add to a winning position, or do you know more traders that add to a losing position? And by far, in my experience, adding to a losing position is way more popular. And that's always a red flag for me, because if it's popular, is that what the 5% are doing? Well, it's unlikely, isn't it? The 5% are doing something different. And so, I'd be much keener to explore approaches where you add to winning positions than adding to losing positions, because I don't see many people doing that. And if we assume that the majority of people are losing and the majority of people add into losing positions, then, you could take a pot shot that was probably, not a great way to approach trading. I'm not saying you can't win that way, but, there's obviously pitfalls in that. I don't know if you do that, but I do that all the time. I say, does everyone agree with this? And, if so, then I tend to question it.
Yeah, absolutely. I think it's a great way to go. In fact, I just dropped off my son at kindy, and the the teacher said to me, she says, "You're doing it. You and your wife are doing a really good job with your son. He doesn't give in to peer pressure. The other kids will say, let's do this and let's do that, and he'll just say, if he doesn't want to do, he'll just say no." I thought, yeah, that's kind of the principle we're talking about here. You know what I mean? Where you just, you look, you say, what's everyone else doing? Everyone else is doing that? Meh, nah. I think that's good for, if you're seeking profits anyway. If you want to be like everyone else, that's cool. But, a lot of people are having problems trying to extract profits consistently. And one of the things I've been working on a lot, lately is just this idea of adding to the winner. And it's been interesting because depending on how you do it, I used to do this a lot about 9 years ago as we record this. So I used to do this a lot, but I did it in a different way, and it was a little bit more risk involved. And the way I'm doing it now is just really adding to the positions, but it's super frustrating because a lot of the time when you do that and you set it up so that if the market goes where you think it's going to go and it goes far enough and fast enough, then it's brilliant, right? But if it kind of meanders and doesn't really get there quick enough, then you end up essentially with a break-even result. So it's kind of all or none, the way I'm doing it. So there's that style of trading that I've learned from some of our forum members and people who are doing this. And so I think it's probably not for everyone. And there are different ways to do it. So let's say that you're buying the euro, you think the euro is going to go up. You might split your position so that you have one position where you're going to add to it as it keeps going higher and higher, and the other one you just kind of leave it as a normal trade where it has a normal trailing exit or a normal target or something like that. Because that way, at least if the pyramided position, if that one gets stopped out at break even, or even it could get tantalizingly close and still leave you with nothing. It's good to have that other position, I suppose, to at least say, well, at least I made something out of this. You know, it's frustrating. It can be and that's why a lot of traders don't do it, right? It's frustrating. It's not natural. People don't like to do that. They say, I bought it, 50 pips ago. Why do I want to buy it now? I'm going to add risk to my trade now. I could end up with a break-even result or something like that. So I see why traders don't want to do it, but that's why, exactly, Darren, that's why it works. That's why it's such a profitable thing to do. If you think you've captured a strong move in the market, then by adding to that position, it's brilliant. I mean, I know you used to do a lot of this trading right on the 4 hours where you were doing sort of stacking positions and that sort of thing.
Yeah, and it's something I'm kind of, looking at again at the moment, and kind of in tandem with letting some trades run a bit more. I think it really is one of the hardest things to do. And if you imagine a trade that was, say, in 50 pips drawdown and came back and you got out at break even, that tends to feel like more of a victory than a trade that was in profit and came back to break even. There's essentially the outcome and the result is the same, but that sort of initial euphoria of having a winning position tends to mean that we tighten things up too quickly. And I think you really need to kind of have this exponential curve of how you take risk off a trade. And it's something I'm trying to look at the moment. So to paint a picture, your initial stop is quite wide, so you give the position a chance to go in your favour. And then as it goes in your favour, you tighten a little bit. And then if it moves to the next level, you tighten slightly more aggressively. And then to the next level, even more aggressively. So you kind of take the risk off gradually. And I think, there's always this element of, we want to get out right at the top, don't we? We want to get out right at the peak of our trade. And I think it's one of the hardest things to learn is to let trades run. But I think it's one of the things that if you master can make the most dramatic difference to your trading. But that only kind of makes itself clear over a long period of trades. And that approach of letting your trades run does mean you're going to have a lot more disappointing trades that looked like they were really good and came back and essentially ended up as nothing or even losers. It's really difficult. It's something I'm really pushing myself to improve on at the moment.
Yeah, I agree. I mean, the point of view that you have to take is sort of like next 30 trades, next 50 trades instead of, I can't believe that last 2 trades did that to me. You just have to adopt sort of a longer term point of view, I suppose, with your data. And I think that's why a lot of traders have difficulties, because they're always looking to adjust on the fly or looking for reasons why that last one missed the profit target by 3 pips or what have you. So, yeah. Yeah,
we kind of want it all determined. And, we seem to think as well that our strategies should be better than they are. And I just don't think that trading is that clear cut, and you can have so many near misses in both directions, and you can't necessarily always make a change to a simple trading strategy that's going to remove that. But that desire is always there to try and remove it, and it's not intuitive to trade. It's just very difficult to do the right things.
Yeah. I think we should talk about that idea right there in a whole episode on its own, because I think it deserves that. The truth there that it's not natural, it's not easy, it's a difficult thing to get right. So I guess if I were to ask you, Darren, you're not interested in trading these reversion to the mean systems where the market goes against you and you keep adding. That's not something that's on your radar?
I have recently been looking at something similar. It wasn't really adding to losing positions, but it was trying to deal with range in markets. But, like I said before, what I found was in the range you had a quite high win rate, but your wins were relatively small. And then when it broke out and trended, you took these big losses. And, in the end, you didn't really make much profit at all. So it's not really for me, but I certainly see people who can make it work, but they still can't avoid the fact that when the market conditions aren't right, they're going to take some pretty large, painful losses.
Yeah. And you can get tricky and try and decide, well, I'll turn it off when there's a trending market or whatever, but that's sometimes it's too late. Sometimes you say, well, when it's a trending market, I'll just turn off my mean reversion system. Well, sometimes it's a trending market and you're already in a trade on your your mean reversion system, so it's a little bit too late. Whoops.
Yeah. But that whole picking the market condition and putting it in like 2 or 3 simple boxes, I can appreciate using that in your trading, but its accuracy and ability to make you consistent profits, I think the movement of the market is way more complex than that. Just to say trending or ranging, I don't think that's really the answer.
Yeah, absolutely. Yeah. Well said. Well, I appreciate your time, Darren. Thanks for spending time here, and I look forward to seeing you next time. And I think next time maybe we can talk about this idea of why is trading unnatural. What is it about trading that's so unnatural, and how can traders deal with that? If you're up for that.
Cool, Walter. I look forward to that, mate.
Okay. See you.